Okay, so I think this recession might be broken because I thought everything was meant to crash. Crypto would go to zero, the stock market would keep on falling, and house prices would suddenly become cheap again. Clearly, it was all just a dream, and we've woken up in a place that feels even weirder, where everything's upside down, not where we left it.
That was fun.
Since the US confirmed that they've had 2 quarters of GDP decline, meaning that the largest economy in the world has just been in a recession, we're now in some kind of hangover period where we don't want to admit what we've done the night before, and we're trying to find a Bloody Mary to get us through breakfast without throwing up. Anyway, this video is going to look at all the different goings on in the stock market, the economy, and the housing market to try and make sense of what's going on and get you up to speed with everything you need to know. As usual, I'll throw in all of the data and give my thoughts on where I think we'll end up. First up, we do need to talk technical before we go into everything else that's really strange right now in the markets. The US has recorded 2 quarters of negative GDP growth, meaning that they have been through a recession. The key part of that statement being that they've been through it. It's happened in the past, not what's coming. You see, all of this data can only really help us looking back. It's like your teenage years. Until you're out of them, you won't realise how moody you really were.
I hate you! I wish I'd never been born!
I say it's a weird one because nobody wants to admit that they've just been in a recession. At least the White House doesn't, but they're really careful with their wording. If you say we aren't in a recession now, then you're probably right because the data is backwards looking. See how this can get very confusing? Anyway, it's also a bit weird here, as in the UK, we're not feeling the same effects. Instead, we're actually experiencing a tiny bit of GDP growth, but don't worry, plenty of forecasters are warning that the worst is yet to come as the cost of living crisis hits come wintertime when bills are set to soar and inflation rears its head again. In the stock market, things get even more confusing, but then they never really made sense. After their worst start to the year for decades, pushing down the major indices into bear market territories with 20% falls, we've now just experienced some of the best 1-month gains on record. So check this out, the Nasdaq, which was hit really hard this year after its huge rise over the past couple of years, has just posted its best ever July performance and its biggest 1-month gain since April 2020. Now, I'm not sure if this is great or awful because it could be the greatest bear market trap of all time, or it could signal that the market thinks the worst is behind us, or it could just mean nothing because the market doesn't care about you, it doesn't care about your stocks, and it doesn't care about your feelings, but who knows? Here's some interesting data back from the financial crash. During the period between 2007 and 2009, the Dow Jones Industrial Average rallied over 5% 8 times and even rallied 10% or more on 4 different occasions. So I suppose you could say that it's not really abnormal. It's all happened before. Then on the flip side, to counter all of this doom and gloom, here's another bit of data that says if you look back from the 1980s onwards to current day, through all of the different bear markets, the average time to recovery is 19 months. However, if the bear market was less than a 30% drop, which is currently what we're in, then the time to recovery is actually really quick. You can see here that during multiple downturns, it's just taken a few months to get back to those sweet highs again. Conclusion? Anything can happen, and remember that the stock market is meant to be forward-looking, but then it can also do some really stupid stuff, leading us nicely to the next section. If you remember earlier in the year when things were really starting to look bad, all of the previously famous stocks on YouTube that had gone to the moon but weren't actually making any money were now getting hit really hard, and the old boring stocks were back in fashion. Finally, Warren Buffett was popular again and everyone wanted to own companies that produce profits all of a sudden. However, I think the meme stock rally of 2020 and 2021 might be back again. So much for a recession. This week, a Hong Kong-based company called AMTD Digital, who IPO'd on the New York Stock Exchange a couple of weeks ago, saw its share price rise 32,000%. It rallied so high that at its peak was valued almost in the top 20 companies in the world, making it similar to JP Morgan and MasterCard. It's still riding high at the moment, slightly down from those crazy highs, but it's still apparently worth more than Adobe, the creative software giant, even though its revenues that I could find said it only did about $20 million compared to someone like Adobe who did $15 billion. The take home from this story, we're either through all of this and the bottom is in, or we're heading for another huge bubble. I think Michael Burry will probably have plenty more fuel for his predictions on Twitter. Jumping over to the crypto market, probably the most speculative areas of the economy, we nearly thought that everything was heading to zero over the last few months. The overall market cap, which hit a high back in November, hitting almost $3 trillion, fell around 3/4 to a low under $900 billion, wiping off huge gains from every major coin, including the big giants like Bitcoin and Ethereum. Bitcoin, which hit almost $70,000 per coin in 2021, saw itself decline all the way to $17,000 back in June, and it was just bad news one after the other. We had Voyager and Celsius get caught up with the whole Luna mess, we've seen accusations of fraud all over the place, more hacks, and generally a feeling of why the hell am I investing my money into dog tokens? Don't worry, I'm definitely not. However, just like in the stock market over the past month, we've seen the pretty quick rise across the market again. Seemingly we're back to being risk on and it's time to go to the moon again. The rise is apparently due to smaller investors buying in rather than any big whales making those moves, as those buyers out there with smaller accounts of under $10,000 are apparently building out their positions compared to the big boys who have actually declined slightly. So if you think we're in a recession or heading for a big crash, there's certainly no signs here, unless you somehow think that the current fiat monetary system is going to collapse. So you better get your Bitcoin now, although I'm not sure that you can pay with it down at the supermarket just yet, nor can you eat it or pay your mortgage. Another area of the market certainly making no sense. Full disclosure, I do own some Bitcoin and Ethereum, but I don't look at that account balance. Zooming back out to the wider economy, there's a ton of data to look at from a macroeconomic perspective and also individual company earnings too, which surely should give us a good indication of where we're actually heading. One of the most famous indicators that people like to use is one called the Consumer Sentiment Index, and it's been put together by the University of Michigan for many, many years. It shows that we're currently in a very bad place. People are really expecting bad things ahead, and not just bad, really bad. If we look at the chart over the past 50 years through different shaded areas which show us all the different recessions, we're actually at a lower point now than we've ever been. June was the lowest reading and July was at least a tiny bit up if you look at the latest data. So again, does this mean that we've reached the bottom? If people are feeling really bad about the economy, they'll probably spend less on eating out, new cars, clothes, etc. And that will have a negative effect on those businesses and so on. However, remember that the stock market can do whatever it wants. There's no rational man here. Mr. Market is about as stable as an elephant on a tightrope. And speaking of companies' earnings and consumers outspending, with everything looking so gloomy, we expect all of the big companies to have some really bad earnings and start making loads less in profits and laying off people as if the world was about to end. But as you might have seen, we've seen some record results from some of the world's largest companies and definitely better than expected considering how much of these companies had already been sold off. We've had companies like Apple posting another record quarter, even though some might argue that they sell quite expensive products and services. You would have expected people to cut back. And then companies like PayPal, Visa and others who you might expect again to see a lot less cash running through their books are seemingly still able to beat their expected earnings, even if those expectations had been beaten down a lot already. I mean, even businesses seem to be spending like there's no tomorrow. Looking at companies like AMD who make high-end chips for data centers, they grew their business on that side by 83% in the year. Where's this recession, guys? And what about the housing market? If you've been keeping a close eye on this, you would have seen that the market's been getting very hot over the past couple of years all over the world. Over in the US, average house prices saw yet another rise in the last quarter, taking the price to $525,000, the highest it's ever been and another couple of percentage points compared to the previous quarter. Zillow, the US-based company who is similar to Rightmove here in the UK, still reckons that over the next year we'll see another 7.8% increase in home prices, which is the opposite view to many others who now think it's time for a massive correction as interest rates push mortgages out of the affordability for most families who might have been looking to get on the ladder or move. Here at home in the UK, we're seeing a similar story with the data pushing the average house price much higher. Nationwide says that home prices grew 11% for the year, but the increases are slowing down just a little. However, there are still major issues with the supply of homes not keeping up with demand, and first-time buyers are still showing strong signs of wanting to get on the ladder before it's too late. Apparently, those buyers are now above pre-pandemic levels and are seeking plenty of help from the bank of mum and dad. What will be interesting is seeing if any of these changes since the Bank of England has just announced a rise of interest rates to a high of 1.75%, which, although still pretty small over the long run, it's not seen this for 27 years. Adding a 50 basis point or even a full 100 basis points on a mortgage calculator could put a lot of people off and make moving house and getting a new mortgage unaffordable. So we'll have to keep a close eye on things to see what will happen over the next year as central banks try to keep inflation under control. Okay, so we get the point. I was going to touch on so many other data points, but I think you're starting to get the picture that nothing is ever straightforward in this business. The economy, the stock market, and everything else in between is all over the place. Seemingly, we've forgotten about the threat of interest rates rising higher, inflation looming its head once again, and massive supply chain shortages. But look, there's always going to be something to worry about, and it isn't going away anytime soon. So what's the answer then, and what do we do as investors with all of our money? What if we've just started to invest, or maybe we're still yet undecided because we're thinking that actually this could be a really, really bad time and a massive bull trap if we're still going to head 20% or even further down in the stock market? Well, look, there's a reason that people often say that you shouldn't try and time the market, and that's especially true if you're able to consistently invest every week or month into low-cost index funds. Sometimes you'll buy when it's expensive, sometimes you'll buy right at the bottom, but you won't actually know until that time has passed. In the end, you'll get an average price which over time will grow your wealth as the global economy improves and things do actually get better. For me personally, nothing will change, and the stats always show that getting started investing sooner rather than later will put you in a much better position. From another position though, if you are an avid stock picker and enjoy picking some individual companies on the side like me, then for sure, times like we've just seen may have turned out to be great times to buy and nibble away at your favourite tech stocks or growth stocks, which are still in great positions in the market but just out of favour and back to reasonable levels. I've certainly been doing that, and I've still not tried to time the market. You can see what I've been buying if you check out my latest portfolio update here on Hargreaves Lansdown, and also keep an eye out for my Lightyear portfolio update, which is another portfolio I have specifically reserved for US tech stocks that I started just a few months ago. That video will hopefully be live tomorrow or this weekend. Whatever you decide to do, I hope that helps things make a little bit clearer. Remember to look after yourself out there, don't make any crazy decisions, and seek help from a professional if needed. Remember, I'm just a guy on YouTube sharing his own thoughts and opinions and investments, even if some of them are terrible. Anyway, thank you so much for watching, and until next time, happy investing.